Imagine opening your phone one morning and discovering you've lost $1 million. Now multiply that by 100,000. That's what happened to one man. In just a matter of months, billions of dollars vanished from his fortune. Headlines around the world called it one of the biggest wealth collapses in modern history. People who once saw him as a financial genius suddenly questioned everything. But here's the surprising part. He didn't lose cash sitting in a bank account. He lost something much more fragile. And once you understand what happened, you'll never look at billionaire net worth, or the stock market, the same way again. When you hear that someone lost $100 billion, it's easy to imagine stacks of cash disappearing overnight. But that's not how wealth works for most billionaires. Today, we're going to uncover the real story behind one of the largest paper wealth losses ever recorded, why it happened, and why the same forces affect everyday investors, even if your portfolio is only a few $100s. By the end of this video, you'll understand why billionaire fortunes can rise and fall faster than most people realize, how stock prices can create enormous wealth almost overnight, and why chasing hype in the market can become incredibly dangerous. Because this story isn't really about one billionaire. It's about how modern markets reward confidence, and punish it just as quickly. Section 1. The Making of a Fortune. Before someone can lose over $100 billion, they first have to build an enormous fortune. In the world of finance, most billionaires don't become wealthy because they receive giant paychecks. Instead, they own pieces of companies. Think about it like owning slices of a pizza. If a company is worth $100 billion, and you own 10% of it, your share is worth $10 billion. Simple enough. Now imagine investors suddenly believe that company will become even more valuable. They start buying shares. Demand goes up. The stock price rises. Without selling a single share, your net worth increases. That's exactly how many of the world's richest people become unbelievably wealthy. Their fortunes are tied almost entirely to stock prices. And that's also where the danger begins. Because stock prices don't only move up. They move down too. Sometimes very, very fast. Section 2. The Illusion of Billionaire Wealth. Here's something many people misunderstand. When the news says someone is worth $180 billion, that doesn't mean they have $180 billion sitting in cash. Far from it. Imagine you own a house worth $500,000. If housing prices rise, and your home is suddenly worth $600,000, you technically became $100,000 richer. But did you actually receive $100,000? No. Nothing changed in your bank account. The value simply increased on paper. The same thing happens with billionaire fortunes. If the stock price doubles, their wealth doubles. If the stock price falls sharply, their fortune can shrink by tens of billions in a single day. That's why headlines about billionaires gaining or losing billions are usually referring to changes in market value, not piles of money disappearing. Understanding this one idea explains almost every massive rise and fall in billionaire rankings. Section 3. When confidence disappears. So what causes a fortune to collapse? It usually starts with expectations. Financial markets don't just price companies based on what they're earning today. They also price what investors believe they'll earn tomorrow. If investors expect incredible growth, stock prices can climb to extraordinary levels. But expectations are fragile. Maybe sales slow down. Maybe interest rates rise. Maybe competition increases. Maybe investors simply become nervous. Once confidence begins to fade, buyers become fewer. Sellers become more aggressive. Prices fall. That falling price creates even more fear, which leads to more selling. This cycle can accelerate surprisingly fast. Think about a crowded theater. If one person calmly walks toward the exit, nobody notices. But if everyone suddenly rushes for the doors at once, panic spreads. Markets often behave the same way. Confidence can build slowly, but disappear incredibly fast. Section 4. The man who lost over $100 billion. One of the clearest examples happened with entrepreneur Elon Musk. As Tesla's stock surged during 2020 and 2021, Musk's estimated net worth climbed to extraordinary heights, making him the richest person in the world. But markets never move in a straight line. During 2022, Tesla shares declined significantly. As investors worried about rising interest rates, slowing economic growth, supply chain challenges, and whether the company's future growth would match the sky-high expectations already built into its stock price. Because Musk owns such a large percentage of Tesla shares, every decline in the stock dramatically reduced the estimated value of his holdings. At one point, his paper wealth had fallen by well over $100 billion from previous highs. Think about that for a second. The company's factories didn't disappear overnight. Its engineers didn't suddenly forget how to build electric vehicles. Customers didn't instantly vanish. The biggest change was something less visible. Investor expectations changed. And when expectations changed, the market value changed. That's an important lesson. Markets don't simply measure reality. They measure expectations about reality. Section 5. Why this matters to ordinary investors. You might be thinking, that's interesting, but I'm not a billionaire. Fair enough. But the same principles affect everyone. Suppose you invest in a popular company because everyone online says it's guaranteed to keep rising. The stock climbs. Your account grows. You feel like you've made a brilliant decision. Then bad news arrives. Maybe earnings disappoint. Maybe interest rates rise. Maybe investors decide the company isn't worth such a high price anymore. Suddenly your investment falls 30%. Nothing about your original shares changed. Only the market's opinion changed. That's why experienced investors constantly remind themselves that price and value aren't always the same thing. A stock can become too expensive. It can also become too cheap. The challenge is recognizing the difference. And that's much harder than it sounds. Here's a surprising truth. The biggest financial mistakes often happen when people believe prices can only move in one direction. History tells a very different story. Every generation experiences periods when excitement pushes prices higher than fundamentals alone can justify. Sometimes those companies eventually grow into those expectations. Sometimes they don't. The problem isn't optimism. Innovation absolutely creates enormous wealth. The problem is assuming today's excitement guarantees tomorrow's success. Markets constantly adjust. That's their job. And every adjustment creates winners and losers. Another hidden lesson? Net worth isn't the same as financial security. Someone with a gigantic fortune concentrated in one stock can experience enormous swings in wealth. Diversification exists for a reason. It won't eliminate risk, but it can reduce the impact when one investment falls dramatically. So what can everyday investors learn from one of history's biggest paper wealth losses? First, never confuse stock price with certainty. Just because something has gone up doesn't mean it must keep rising. Second, understand what you're buying. Don't invest because social media says everyone else is making money. Know how the company earns revenue and why people believe it can grow. Third, remember that volatility is normal. Even outstanding companies can experience major declines. That's part of investing. Finally, think long-term. The stock market has always rewarded patience more consistently than panic. Short T. Headlines create excitement. Long-term discipline builds wealth. The story of the man who lost over $100 billion isn't really about failure. It's about understanding how wealth is created, and how quickly market values can change. Billionaire fortunes often look permanent from the outside. In reality, they're constantly moving with investor confidence, expectations, and stock prices. Today's richest person may not hold that title forever. Markets evolve. Businesses evolve. Opinions evolve. And that's exactly why investing requires humility. The biggest lesson isn't that someone lost an extraordinary amount of money. It's that markets remind everyone, whether you own 1 share or 1 billion shares, that prices can change far faster than most people expect. Understanding that simple truth may be one of the most valuable financial lessons you'll ever learn. If you enjoyed this breakdown and want more stories that explain money, investing, and the hidden psychology behind the world's biggest financial events in plain English, make sure to subscribe and turn on notifications. And if this video changed the way you think about billionaire wealth, you'll definitely want to watch our next video, where we break down another fascinating financial story and reveal the lessons every investor can use. Thanks for watching, and I'll see you in the next one.